Welcome to the Treasury Update podcast presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in. On this special edition of the podcast, host Craig Jeffery interviews co-author Kevin Coldiron on the book The Rise of Carry, the dangerous consequences of volatility suppression, and the new financial order of decaying growth and recurring crisis. The organizing theme of the book is largely captured in the title. Coldiron provides examples of and arguments that explain how the use of carry trades and the impact that excessive financial backstopping of natural volatility invariably creates greater volatility for all market participants and the global economy. This rapid growth of carry trades will inevitably lead to faster and deeper corrections that reflect an increasingly distorted market. Listen in as they discuss the concept of carry and its historical and looming consequences.
Welcome to the Treasury Update podcast, Kevin.
Thank you. It's great to be here. I appreciate you having me.
The title of your book released this year in 2020, The Rise of Carry, the Dangerous Consequences of Volatility Suppression, and the New Financial Order of Decaying Growth and Recurring Crisis is a mouthful, but it certainly has there's a negative outlook on the extent of volatility suppression that has been occurring and increasing, and the implications from that. Maybe we should start off with why people should listen to this discussion, and then read your book.
The book will help you kind of understand and answer some of the questions that I think a lot of us are asking, like why has the market gone through these incredible bull phases and then crashes over the last 25 years? Why does it seem like the S&P consistently outpaces what's going on with the real economy? And why does the Fed seem so omnipotent? And is it really omnipotent, or is it just an illusion? So those were some of the ideas that we've tried to kind of tackle in the book.
You know, the rise and risk of carry is the concept. The book is The Rise of Carry. This episode we're calling The Rise and Risk of Carry as part of the interview. Maybe you could follow that introduction of why to read with an explanation of carry. What is carry from the mindset of either a regular business person, or maybe even someone in finance who may not be familiar with some of the terms and the concepts here? Sure.
In the book, we talk about carry as a trade that makes money if nothing happens. And it's essentially it boils down to really like a levered yield spread strategy. So I'm guessing that a lot of your readers would be familiar with probably the most important classic carry trade, which is a currency carry trade, right? So you would borrow in a currency, let's say the yen, with zero interest rates, and invest in a currency like the Aussie dollar, which used to have much higher interest rates, let's say 5%. So you've got a 5% yield spread. And if you're able to lever that trade, you could get 20 or 30% annualized expected yield. And as long as nothing happens, right, as long as the Aussie dollar doesn't depreciate, that's a profitable trade. The risk is that something does happen, that volatility emerges, that the Aussie dollar depreciates, and that the yield spread you've made, which is the carry, gets wiped out by the depreciation. So that's kind of the classic example. And it's interesting in that example that it's really good to be early in these trades, right? If you're the first to recognize this and you go long the Aussie dollar and then other people come in behind you, then you might even benefit from capital appreciation, right? Other people entering the trade pushes the Aussie dollar up, and you make not only the carry, the yield spread, but also a capital gain. That's kind of the classic example. And what we've talked about in the book is now we're starting to see trades that have those features everywhere, right? Not just in the currency markets. For instance, stock buybacks. If you're issuing debt to buy back your stock, that can be a carry trade. Like American Airlines, I was looking at their data earlier. They've been able to issue debt or in the kind of range of 4 to 5% over the last 5 years, and the return on equity has varied a lot, but it's kind of averaged in the mid-teens. So you can issue debt at 4 to 5%, buy equity with a return of 15%. If nothing happens, if the operations stay stable, the return on equity stays stable, you're able to finance that debt. That's a carry trade. And we've seen stock buybacks explode. And in fact, the corporations via stock buybacks have been kind of the only consistent buyer of U.S. equities over the last decade or so. So they become very, very important.
Yeah, okay, so you've given a couple examples, stock buybacks and the FX situation where, what would be an example? You talked about the Aussie dollar. Someone's putting a factory up someplace and they find it cheaper to get their financing from Australia, even if they're building it somewhere else around the globe.
Yeah, I'm glad you brought that up. That's really important. So my example was more kind of like a currency trader type of example. But what we're seeing more and more over the last decade is corporations themselves engaging in trades that are essentially carry trades. So in your example, well, an example that we talk about in the book is, say you're a corporation in an emerging market like Turkey, where local interest rates are really high, and you have a project, a factory or something you want to build. If you had to finance it at those local rates, it might not be viable. But if you can finance it in dollars or yen at much lower interest rates, and you're willing to accept that currency risk, then all of a sudden the project becomes profitable, right? So the acceptance of currency risk, the currency carry trade risk, allows more, economic growth than you'd otherwise have. So that's important, because what it means is that as carry is growing, you see more growth, more liquidity, and more debt building up than you otherwise would have. So the world seems, in some sense, rosier and better because people are willing to accept this kind of currency mismatch. I mean, there's even been studies that have looked at Chinese companies where companies who have access to dollar funding will borrow in dollars, convert that to local currency, and then lend it on to other companies in their industry who don't have access to dollar markets. So they're basically acting like a bank and doing currency carry trade. So that's important, that we've seen carry trades spread from kind of pure, what we might call kind of financial traders, to non-financial companies doing it in different forms.
Thanks for that example of the Turkish factory, I think you said, and yeah, that's a good example in the book, and maybe we can explore that more in a few moments. But getting to this point about carry, the example of the currency trader may not resonate with corporate treasury, but the other example of where we're borrowing and tapping the debt and capital markets across the globe and how that capital is deployed probably is more interesting. But maybe we could talk fundamentally about why does this matter? Is less volatility good? Is more volatility bad? I mean, typically if there's some suppression of volatility, that is what we're trying to do. At least treasury professionals try to reduce volatility in line with their expectations, in line with their risk profile. And so if we can suppress it, that's bringing it, in line with our risk appetite, and we want to do that. But what you're saying is something fundamentally different. We're not doing that.
Yeah, so I think what you're saying is that, a treasurer through their own activities can, reduce or minimize volatility of their portfolio. And of course, that's a good thing. And that's what, professional money managers are aiming to do. When we talk about volatility suppression, we mean something different. We mean, central banks acting in a way that artificially kind of suppresses the volatility of risky assets. So if we think about the VIX as being kind of the global price of risk, what we're saying is that's been through the activity of carry traders and through the central bank, that's kept that measure artificially low. So carry trades are basically a form of shorting volatility, selling volatility. So as carry trades grow, it caps volatility, keeps things artificially low, which we think is bad, because if you think about like a free market, price is exceptionally powerful indicator, right? It's summarizing what's going on with the supply and demand in the underlying market. And as long as it's a free market price, it's a very powerful indicator. But if it's artificially suppressed, then it's not giving us the right signal. If it's telling us that, volatility is low, that could actually encourage more risk taking. Your treasurers could see their portfolio as being less risky than we would argue they actually are. And what happens is that risk emerges in what we call carry crashes, recessions, and that causes people to say, oh my gosh, my portfolio is a lot riskier than I thought. I need more liquidity than I thought I did, and you have this rush for cash, which we saw in March and we've seen in other crashes. So we think it's better if risk measures are allowed to evolve kind of freely, and we can see risk developing in the system rather than just coming at us occasionally.
You were identifying, it seems to me, two hazards. One is the moral hazard of you don't bear the cost of the risk you're taking. And this is the example of, let's say, central banks stepping in and smoothing out markets so you don't bear those risks in, maybe in normal times or normal risks that you should be suffering from versus the extreme cases. So that's the moral hazard. And the other is, maybe you didn't say this, but I was taking it as the ignorance hazard. We're not sure that we're actually taking some of these risks on, whether it's with short-term assets or some aspects of the carry trade. We think historically it's been low. We're not really realizing it as a volatile risk or as big of a risk that it is. Is one bigger than the other, or are they both the same, or am I overplaying the argument?
Oh, that's a good question. The second risk is personally greater to me because my career has been in money management. I'm a lecturer now, but 25 years I managed portfolios, many of them levered. So I always felt like, if I understood the underlying conditions as clearly as possible, then I felt pretty competent managing my risk. And I suspect your listeners are in the same boat. So I think the artificial suppression of volatility and then the portfolio decisions that leads to is the bigger risk. And in fact, I think the intervention side of it is a function. The intervention becomes necessary because the artificial suppression leads people to hold portfolios that they probably shouldn't have, that they wouldn't hold if they truly understood the underlying risks. So I think you could deal a lot with the intervention risks if the overall market price of risk was a more accurate reflection of what's going on with the economy.
You mentioned March, as everybody was returning home in COVID or moving home, the shelter-in-place activities. There were some issues with the money markets, right? The most liquid assets, which we talk about, it's super liquid. Some assets couldn't be sold and converted to actual cash in the money market and in your bank account. There was a potential that it was going to freeze up, like we had seen more than a decade earlier. Some assets couldn't be sold. Central banks, the Fed stepped in. They kept the markets flowing. Instantaneously they bought stuff. They said, basically limitless buying. The Fed, perhaps the ECB, Bank of England. I'm not sure if Bank of Japan did the same thing, but they kept that flowing. Is that type of intervention useful and helpful, or is that dangerous because it's not letting the market realize the risk they had on these shorter term assets that were paying more yield than having the funds just sit in their account?
There's a lot in that question, really good points. So let me just start by saying that a key theme in the book is that what we call the carry regime, the growth of carry. One of the features is there's a tendency to, because volatility again is artificially low because of all this volatility selling, and interest rates on conventional cash in the bank, Fed reserves, are also very low. The demand to hold cash gets increasingly satisfied by what we call money-like assets or money substitutes. Basically the things you talked about, right? Short-term liabilities issued by banks or corporations that offer a higher yield, and they get treated as money. So instead of holding cash, which yields nothing, people are holding these instruments. But then when a crash happens and these risks, the underlying risks in those assets are revealed, then everyone wants cash. Everyone wants the real thing, and you get this, dynamic of what we saw in March and what we saw in 2008. So that's a feature of the carry regime. Going back to the question, was the intervention justified? Personally, and I should be clear, like I don't want to speak for Tim or Jamie, my co-authors, who may have different opinions. My personal opinion is that given the level of economic pain we're in right now, and that we're going to continue to experience, the Fed saying, okay, sorry, now's the time we're going to teach you a lesson. There's a lot more risk in these assets than you realize, and we're not standing behind them. I think that would have been kind of politically suicidal. And also just from a societal point of view, not a good idea. So I think the interventions in this case probably had to do, but step back and say, well, what does that mean? That basically means we've broadened the definition of what money is, right? Money is now not just bank deposits and federal, reserves with the Federal Reserve. It's liabilities issued by a range of financial institutions around the world. And that's what the swap lines were there to do, right? Those institutions could no longer get dollar funding, so the Fed provided it. Fed's basically saying that's money. Short-term commercial paper, short-term debt issued by companies that are held in money market funds, that we're saying that's money too. In the heat of the crisis in March, I called up Vanguard and said, okay, I want to switch all my money from my prime money market fund to the Treasury money market fund. And they did it. Overnight, it was done. Now, my trades aren't going to move the market, but you think about that, that's actually a really valuable thing I was able to do. I was basically within 24 hours eliminated credit risk from my cash holdings. And, that didn't cost me anything, right? That's a real valuable service I got provided for nothing. And, if that's happening globally, which it was, someone's providing insurance for free. And we know, right, that if we talked about market prices, something is being provided for free, a lot of people are going to use it. And that's what we're seeing, right? So I think that the insurance that the Fed is providing is somehow underpriced. I'd like to see it be more difficult, less liquidity somehow, which I'm sure your listeners are thinking, boy, that would be costly, and I don't want that. But I mean, there is a price to be paid somewhere for that insurance.
Yeah, and in really challenging times or times of great disruption or volatility, it is interesting to see what happens to these assets and where cash moves. I mean, the repatriation of funds was, back to the U.S. was massive in a very short period of time. Everyone was converting to cash. Any other comments about the volatility that's been playing out in this past year, let's say the first six and a half months of 2020?
Well, you talked about the money returning to the U.S. The currency market moves were fascinating and pretty much exactly as we expected, right? So when in the early part of the crisis, you had both the yen and the euro rise dramatically against the dollar, which is a little bit of a head scratcher until you think that these were currencies with very low interest rates that were used to fund carry trades in emerging markets. So as those carry trades start to lose money because they're levered, traders have to get out of them. And so you had this very short period of time where I think the yen went up by almost like 10% against the dollar in a short space of time, just unprecedented move as the carry trades were unwound. And then you had the second phase of the crisis where there was a lack of dollar funding. Then the dollar started appreciating against these currencies as everyone was scrambling to get dollars. So that was very notable. The other notable thing is that the movement in the VIX, the measure of implied volatility of the S&P, was incredibly violent, much more so than in the 2008 crisis. I mean, the VIX went to its peak, I think, in less than half the time it took after the Lehman bankruptcy. And I think a big part of that was because people who had essentially sold insurance, which is a carry trade, against a rise in volatility, really had to scramble to hedge that position. They do so by buying volatility. And that just led to just an enormously violent spike in the VIX, which suggests that there's a lot more carry trading going on now than there was in 2008. So I guess just the violence of the moves and volatility in some of these markets is, I think, pretty strong evidence that the level of carry trading has continued to grow.
So as those organizations, whether they're traders or whether it's companies, doing normal business, they've sold protection against volatility. They became an expected insurer, an unexpected insurer.
Yeah, you sell protection, you're an expected insurer, right? You know that you're exposed to movements in volatility. You can sell naked insurance, right? So if you'll allow me to use a little bit of technical terms, if you look at the volatility markets, which play a central role in our book, typically a 1 or 2 month VIX future, so forward volatility, trades at a couple of percentage points higher than the current level of volatility. So I can sell you protection against the VIX in 2 months' time. And if I don't hedge that at all, if nothing happens, I'll make money because I'm typically selling that at 2 or 3% higher than the current level of VIX. And so if the future price just moves down to the spot price, what we call the roll down, you'll make a couple of percent. So if you're selling unhedged volatility, on average, you're going to make a profit. That's called the volatility risk premium. If volatility starts to move higher, you're in danger of losing money very quickly. And so you might decide, okay, I need to hedge that position by buying futures contracts. And that reinforces the move up in volatility that's already happening. If you get that happening with enough people, you can get these kind of basically reinforcing bank run type of effects. So you're hearing me tell the same kind of story in different markets, that when the world stays calm, everything's fine. When it starts becoming more volatile, people have to close positions, which reinforce moves against them. And that's a very simple example. There's much more complicated hedging examples that go on in the volatility markets. But people know, I guess to answer your question, people know they're selling insurance and they expect to make money on average. And then their hedging activities to guard against downside risk can really reinforce market moves.
Yeah, just the wrong time. I want to talk a little bit further about current volatility. The concept of, the central bank, the Fed, for example, has been holding interest rates down since the financial crisis. So over a decade, they've been artificially pushing them down, and then quantitative easing and tightening and some of those regimes. Their actions, fiscal actions, et cetera, they matter. And since COVID-19 started rolling out, they've done some very significant things in an extremely short period of time by any measure, any historical measure. Is this changing or modifying your thinking in any way, or is it confirming some of your thinking put forth in this book? Maybe you could explain how that's, reinforced it or helped you put some more calibration on some of your comments in the book.
Yeah, it really reinforces, in some sense, the response has been even stronger than I think I might have expected, but it definitely reinforces what we thought of in the book. And, if the market had fallen 20% and that didn't require Fed intervention, then that might say, hey, you've overstated your case. The market's not as sensitive to movements down in the S&P. It's not as sensitive to the VIX as you said. But in fact, when volatility spiked, when the market went down, as you said, we saw a range of interventions that we've never seen before in a very, very short space of time, particularly in the corporate debt markets, which I think was absolutely critical. So going back to this point that I said earlier, that during the growth in the Kerry regime, people are using money substitutes in replace of cash. And the fact that most of the interventions were focused on supporting those kind of money substitute markets, right? The money markets and really the underlying corporate bond markets suggests that this substitution effect was much greater than even we maybe had expected. So yeah, I think it's absolutely fascinating and somewhat shocking that even non-investment grade corporate debt has been included in the assets that the Fed was willing to buy. I personally would have expected them to stop at investment grades, but clearly they felt that they needed to underpin that part of the market as well.
The concept of the disease and the cure, this is the dangerous part of what you've been discussing in your book and today. How do we understand the level of danger that arises from suppression? When does the cure become worse than disease? When does it puts too much pressure and eventually it explodes or breaks out? When can that happen? Why can't we continue with the Fed with their unlimited ability to grow their balance sheet? Why can't that protect the world forever? Maybe that's overstated, but you know what I'm getting at.
I do, and I think that's what the Fed would say, right? And honestly, that's probably the view of most people, that we just need to get through this particular crisis and things will be fine. I would just say that let's walk back in time a little bit. I mean, you and I, sadly, are both old enough to remember long-term capital, right? And in some sense, that was kind of the beginning of all this, right? And the Fed didn't even directly intervene in the markets. It organized a private bailout of long-term capital, and long-term capital was essentially engaging in a variety of different carry trades. And the worry was when they blew up, it would take down the financial system, or at least some of the key players, so the Fed wanted them to be protected. And then they were, lauded for that, and it seemed like it was successful. And they didn't even have to do anything themselves. And then we roll forward to the 2008 crisis, where turns out carry trading wasn't just confined to one speculative hedge fund, but it was happening all across the key investment banks. And so the range of interventions that we needed to support the system then became much greater. I mean, think about it. When you and I started our careers, talk of quantitative easing would have been heretical, right? There was just something, well, the Fed buying government bonds? No way, that's not ever going to happen. And that rolled out in 2008. It was controversial. And that was supposed to be temporary. The Fed was going to unwind its balance sheet. It tried to do that, and the market, complained. Volatility spiked, and they said, okay, no, we're not unwinding the balance sheet. And now we've had another crisis, albeit a bigger one, and one that was at least partially triggered by an external event. And the range of interventions has been even greater. So it's not a stretch to imagine. I mean, I think the next thing the Fed will have to do is buy equities, right? The next crisis we'll probably see the Fed buy equities, and then what have we got? Do we have a free market economy when the government is, supporting the allocation of, equity capital? So I know what you're saying, and like each intervention looks defendable, and probably in some level is defendable at the time, but they seem to be ratcheting higher and higher.
Yeah. Now, I mean, when you mention the buying equities, I think about General Motors. What happened last time? They acquired equity, and the creditors took a different position than had historically been the case. So it changed the order of the financial market. I know there's quite a bit in your book that talks about those things and what occurs with, not necessarily about GM, but there's a lot of how this creates a different type of moral hazard, and that's that's more than another podcast. It's probably a couple longer discussions, and it's quite fascinating what you cover in the book. But I would say that the Fed has, through the government, maybe not the private ownership of the Fed, but the government has acquired industries in that. Not just picking winners and losers or pushing them together, but taking equity stake in some companies. So, yeah, just interesting.
The Treasury obviously did that with banks in TARP. They took an equity stake. Actually, I think that turned out to be quite an effective intervention at the time. What I'm talking about is just kind of like open market purchase of risky assets
to support prices or something.
Yeah, to support the market. It just seems like we're inevitably headed to that. Things that we thought were unthinkable become thinkable very quickly. The Fed buying junk bonds, for instance, I would have thought that was unthinkable a couple of years ago, and now it's not. So I don't think it's a stretch to imagine the Fed buying S&P index funds. And in fact, I've heard stories, and this is just, talking out of school a little bit, but friends of mine who manage money who say that, the fear of the Fed actually directly buying equities led to a lot of funds. Some funds will typically, if they want to hedge some market risk, they'll short S&P 500 ETFs or futures as just kind of a generic hedge. And they sort of realized in March, hey, we could be on the wrong side of the Fed actually coming in and buying equities. So those hedges got taken off. And that was part of the reason you had this kind of violent upswing in the market, in late March and early April, is that this fear that, you didn't want to be betting against the Fed if they really got aggressive. Now, again, that's gossip. I don't have data to back that up, but I do think it's interesting to at least contemplate.
I wonder if that means, would that be defined as the immoral hazard? If the moral hazard is someone protects you against the consequences of what you're doing, the immoral hazard is someone, for the guise of doing good, impacts someone else. But that gets us down a different rabbit trail. When we were talking and doing some prep the other day, I think I gave the example, a friend of mine, talks about, I can't remember if it's a pig or a turkey. He says the turkey thinks the farmer loves him more than all the other animals. He protects him, feeds him until, it gets closer to November and things change rapidly. And the question is that the type of scenario we're looking at as we're like, oh, okay, long running equity buildup, cheap money in different places around the globe, the Fed or whoever's protecting us. What's a perspective you would encourage people to take?
In that analogy, the markets are the turkey, right? And the Fed is the farmer. I don't think the Fed is fattening us up to cut off our heads. That they're going to, their actions are clearly, we're going to do what it takes to support the economy. And that's in their DNA. And they, that the Fed exists to provide liquidity in a crisis, and it has a mandate to support maximum employment, at least consistent with moderate inflation. So the Fed isn't going to suddenly withdraw support. The question is whether or not the market will lose confidence in the ability of the Fed to support the markets. And I think that's where this ratchet idea, each time the market is testing, how much do you love us? You know what I mean? Mm-hmm. Do you love us enough to buy investment grade bonds? Okay. Do you love us enough to buy junk bonds? Do you love us enough to buy equities? I mean, I think that's the nature of markets. And you and I talked about that. They're going to continue, like teenagers, they keep testing you. And so the Fed will be tested. And if at some point the markets decide they're not getting enough support, then there's nothing there. And I think that there is the potential for a big correction. So we do talk about in the book that the end of the carry regime is likely to come from inflation. And that might seem a bit strange because we're in a period of deflation right now. But ultimately, the carry grows, debt grows as well. And a way out of debt is to inflate it away. And my personal opinion is that there's an important political dimension to this, which is that debt inflation favors borrowers over lenders. And, in democracies, at least in our democracy, the people in power right now are the asset owners, the lenders. And the people who owe the money are typically younger and don't have as much political power. But that could change a lot in the next 10 years. The political dynamic could favor inflation more so in the next decade than it has in the last couple decades, I think.
As you look forward, and maybe from a prospective or recommendations perspective, maybe it's what do you wish people knew or understood about some of the themes and messages of your book, and maybe take it from a central banker view, politician, and corporate treasurer. What should they think? How should they communicate with their constituents? And what should they do? I know this is a real softball, right? 3 different constituents, all perspective. Pick anyone. I can bring up the other ones. I know that's a multi-layered question.
Yeah, no, sure. Well, let me start with treasurers because they're market participants, and I would say two messages from the book. One is that crashes are part of the system. They're not black swans. They're not thousand-year floods. In a world that's dominated by carry, you're going to see periodic crashes. So you need to prepare for that. Secondly, because I know corporate treasurers have an interest in, currency carry. Currency carry is not an independent strategy anymore. If you looked at the data up until, the late 1990s, currency carry strategies behaved, quite independently from global markets. That's not the case anymore. The main risk in currency carry is a spike in the VIX. So when there's a global economic downturn, when volatility goes up, currency carry trades do poorly, both short and long term. So you talked about treasurers looking to suppress volatility, manage volatility. Just know that volatility, the volatility of your currency positions is going to be pretty closely tied to what's going on with the S&P and the VIX. It's not as diversifying as it used to be. For politicians, I got a lot of things to say to politicians, but a lot of the interventions that we scramble to do during these crises are designed to protect workers, as they should be. And we've been trying to protect them in this kind of top-down approach by bailing out the institutions that employ them. It might be better to provide that insurance directly, right? So we have some form of retirement insurance in this country. If people had also access to health insurance and kind of income insurance, either a universal basic income or extended unemployment, we wouldn't, we could be a little more confident that there was a floor under living standards. And therefore, when companies come to politicians, like you said, General Motors or like the airlines, and say, we need to be bailed out or else we're going to lay off lots of people, you're in a stronger negotiating position. Obviously, no one wants people to be laid off, but if you had a confidence that there was a floor under living standards, you couldn't be pushed into doing bailouts at unfavorable terms. And I actually think this administration has done a better job negotiating. And then the last thing I would say is set your bailout terms ahead of time. If you're coming to the government for a loan, expect the following. We're going to want an equity stake. We want a seat at the board. There's going to be caps on CEO compensation, and buybacks are going to be capped until the money's repaid. Set that up ahead of time, just so you know, and that again, you're not negotiating under strain. With central banks are the trickier ones because they, in some sense, I think, have the toughest job. I would just say, appreciate that the interventions you conduct mean that the next one are likely to have to be larger, and try to think through where that ends. Don't deny that your interventions don't have knock-on effects in terms of encouraging risk-taking, because they do. And then try to, where you can, charge for your services. You're providing insurance. And clearly, I think their logic is, well, society benefits from this insurance. I'd like to see the institutions who are the most direct beneficiaries pay for it a little more directly. And they've done some of that with the new facilities. There's, I had to kind of chuckle. One of the facilities, they set up I think it's the primary market corporate credit facility. someone was commenting, well, it's too expensive, no one's going to use it. Well, that's the point, right? You want to make it, expensive enough that people aren't relying on the Fed for credit, which is probably easier said than done, but that would be a message for them.
Interesting. Yeah, I did not expect you to mention universal basic income, but it was interesting. I particularly liked your comment to corporate treasurers about the crashes are going to happen. They're going to occur. Everything's not a black swan event. You can't say nobody could have anticipated that. Just because things don't happen exactly the same way doesn't mean there's not volatility that breaks out. There's a recovery. How you respond to that. And it is, from a behavioral standpoint, you do put a lot of information in the book about that and some of the views there that if you continue to provide, protection against the moral hazard, you're going to get more of it because you're covering it. It's like, hey, I didn't suffer that. It's kind of like you're driving the car. It's like, oh, my brakes are better, my handling's better. I can go faster and faster and faster. And we continue to adjust so that now we're speeding 25 miles an hour faster because our brakes, work and, that much better. So we keep removing the margin of safety we're trying to put in there. So that's for risk managers or corporate treasurers, I think there's a lot to think about there. Kevin, you've been very generous with your time. This is a great conversation for me. Hopefully it's interesting to listen to for others. Any final thoughts that you'd leave the audience with?
I just wanted to say I appreciate your time, and I'm glad to have the opportunity to get some of these ideas out there. And I would encourage people, if they do look at the book, there's some technical aspects to it, and that might be, you might not be interested in the gory details of how the VIX futures curve works. That's fine. In the last third of the book, there's some really interesting kind of higher level commentary on how carry reinforces some of the inequalities we have in our society. Essentially, the support or the bailing out of carry traders who tend to be wealthy and connected to begin with reinforces their existing advantage. And so there's also that element to the book where I think is accessible and important for people, even if they're not, like I said, interested in all the gory details of the VIX futures curve.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.